Welcome to the Financial Freedom Blueprint for your 20s. In this video, we'll walk through a practical, non-negotiable order of operations to help you crush debt, build savings, and invest consistently. We'll start with a quick agenda and a brief disclaimer, then move step by step through the 3 phases: secure and eliminate, reinforce and protect, and hyper-accumulation. Finally, we'll round out with budgeting systems and key takeaways. First, we will cover Phase 1. How to secure your foundation and eliminate the worst debts. Next, we will transition into Phase 2 to reinforce your finances and protect against setbacks. Then, we will move into Phase 3, where we focus on aggressive, consistent investing. After that, we will examine budgeting systems that are easy to stick to. We will include short quizzes along the way, and we will finish with key takeaways and next steps. Before we begin, a brief disclaimer. This content is for educational purposes only and is not financial, legal, or tax advice. Your situation is unique, so please do your own research and consider speaking with a licensed professional before making major financial decisions. Now, let's move into the high-level roadmap for the entire blueprint. To orient you, here's the 3-phase roadmap. In Phase 1, you'll create a small emergency buffer, grab any employer retirement match, and aggressively pay down high-interest consumer debt like credit cards. In Phase 2, you'll build a full emergency reserve of 3 to 6 months of essential expenses and tackle medium-interest car loans, using the 8th of March 20 rule for future purchases. In Phase 3, you'll maximize tax-advantaged accounts and invest consistently in low-cost index funds to accelerate compounding. With that overview, let's dive into Phase 1. First, set up a mini emergency fund. Aim for $1,000, or whichever amount equals your highest insurance deductible. Keep this in a high-yield savings account for easy access. The goal is to prevent small emergencies from pushing you back into credit card debt. Automate a transfer from each paycheck until you reach the target, then redirect that transfer to the next priority. Next, to set this up quickly, use a high-yield savings account and automate a modest amount per paycheck, for example $50 to $150, until the goal is hit. Direct any tax refunds or side hustle income to this fund to accelerate progress. Avoid increasing discretionary spending until you finish this step. Quick quiz. Which comes first in this blueprint, capturing the employer match or funding the mini emergency fund? Options are A. Capture the employer match first. B. Fund the mini emergency fund first. C. Do both equally at the same time. Or D. Skip both and start paying debt. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Fund the mini emergency fund first. Establishing a small buffer prevents small emergencies from causing new debt. Once that is in place, you immediately capture the employer match for a guaranteed return. Now, let's move to the next step, capturing the match. Now, capture your employer match. Contribute at least enough to receive the full match because it is a guaranteed return. For example, if your company matches 4%, contribute at least 4% of your salary. Automate contributions and allow compounding to work over time. You can refine fund choices later, but the key is to start now. With the match secured, we move to the most expensive threat, high-interest debt. Then, attack high-interest debt, especially credit cards and any loans with high annual percentage rates. List your debts with balances, minimum payments, and APRs. Prioritize the highest APR first for the best mathematical outcome. Simultaneously, free up cash flow by trimming subscriptions, eating out, and daily impulse purchases. Use milestones to maintain motivation. After you clear high-interest debt, you'll be ready to reinforce your defenses in Phase 2. Before moving on, let's compare 2 payoff methods. The debt avalanche targets the highest APR first, which is mathematically optimal and reduces total interest paid. However, it may feel slower early on. The debt snowball targets the smallest balance first, creating quick psychological wins that boost motivation, though it can cost more in interest. Choose the method you're most likely to stick with. Consistency is the most important factor. Now, let's reinforce your finances in Phase 2. Moving into Phase 2. With high-interest debt eliminated, it's time to fortify your finances. You will build a full emergency reserve and tackle medium-interest car debt, which often blocks early wealth building. Let's start with the full emergency reserve. Next, Build a full emergency reserve covering 3 to 6 months of essential expenses. Keep it separate from your checking account to avoid accidental spending. A high-yield savings account is appropriate for liquidity and safety. Aim closer to 3 months if your income is very stable, and 6 months or more if your income is variable or your job security is uncertain. After your reserve is complete, address the car loan trap. Then, focus on the car loan trap. Medium-interest auto loans can delay wealth building by consuming cash flow. Pay them down aggressively. For future purchases, follow the 23-8 rule. Put 20% down, limit the term to 3 years or less, and keep total monthly car payments at or below 8% of your gross monthly income. Favor reliable used vehicles to reduce depreciation and avoid payments that crowd out saving and investing. With your defenses solid, it's time for Phase 3. Here are quick examples of the 8% payment cap. At $50,000 gross annual income, 8% of gross monthly income is about $333. At $60,000, it is $400. For example, car prices of $18,000 and $24,000. The 20% down payments would be $3,600 and $4,800 respectively, with a maximum term of 36 months. Adjust the numbers to your actual income and car price, keeping the proportions constant. Second quiz. You earn $60,000 per year. According to the 23-8 rule, what is the maximum acceptable monthly car payment? Options are A. $300, B. $400, C. $480, D. $600. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. $400. 8% of gross monthly income at $60,000 per year, $5,000 per month, equals $400. Staying under this cap ensures that cash remains available for savings and investing. Now, let's accelerate into Phase 3, hyperaccumulation. Now that your debts are managed and your emergency reserves are in place, it's time to accelerate wealth building in Phase 3. You'll focus on maximizing tax-advantaged accounts and investing consistently in low-cost index funds. Let's begin with maximizing those accounts. First, in Phase 3, maximize tax-advantaged accounts. Use a Roth IRA for potential tax-free growth and withdrawals in retirement, subject to rules and income limits. If eligible, consider a health savings account, which offers a triple tax advantage: pre-tax contributions, tax-free growth, and tax-free withdrawals for qualified medical expenses. Increase contributions to workplace plans beyond the match as your cash flow allows. Always verify current annual contribution limits and use automatic annual increases if available. Next, let's talk about consistent investing. Next, invest consistently in broad, low-cost index funds such as total market or S&P 500 funds. Automate contributions because time in the market is generally more important than timing the market. Rebalance periodically according to your risk tolerance and keep fees low. Each time you receive a raise, increase your contributions. Now, to make all of this stick, you need a budgeting system you will actually use. To ensure your plan sticks, choose a budgeting system you will actually use. The zero-based budget assigns every dollar a specific job. The envelope method separates spending categories physically or digitally. Start with a 30-day spending audit. Track every expense, identify leaks like subscriptions, eating out, and small daily purchases, cancel or cap low-value spending, and redirect the savings automatically to debt payoff and investing. Use alerts and spending caps, set a weekly money check-in, and implement a 24-hour impulse list to reduce unplanned purchases. Next, let's visualize your monthly money flow. This diagram shows the path of each paycheck. First, funds flow to the employer plan to capture the match. In Phase 1, remaining funds build the mini emergency and then attack high-interest debt. In Phase 2, cash builds the full emergency reserve and then accelerates the car loan payoff. In Phase 3, cash flows primarily to investments. Finally, remaining funds cover living expenses and sinking funds. This sequence keeps priorities clear and automatic. To recap the essentials, start with a mini emergency buffer, capture the employer match, and eliminate high-interest debt. Build a full emergency reserve, and then tackle car loans with the 23-8 rule. Maximize tax-advantaged accounts and invest in low-cost index funds. Choose a budgeting system you will stick with, and audit spending leaks. Automate as much as possible, and increase contributions with every raise. In summary, start small but start now. Follow the sequence without skipping steps. Use automation to make progress by default. And let consistency rather than perfection build your wealth over time. You now have a clear blueprint to move from overwhelmed to in control. Thanks for watching. If this video helped, please like, share it with a friend, and subscribe for more content on building wealth in your 20s. Tell us in the comments which phase you are in and what your next action is. See you in the next one.